Hey guys, I just want to let you know that I appreciate everything that's going on the channel over the last year. I can't say enough thanks for everybody that subscribed to the channel, hit the like button. I had one video that had over 10,000 views in the last 4 months that really brought some publication of my channel to some other YouTube channels, helped me out a little bit. I've told people in the past, I do this because I love to give information to people. I don't make any money on anything. I'm just here to help you guys out as much as possible with finance. And ultimately, I've been doing that for the last year now. The 1-year anniversary is actually this Friday. I had some extra time today, so I decided I'd go ahead and live stream. And hopefully we'll get someone to pop in here in a few minutes and we can chat for a little bit about some finance and or what else that might be on your mind. Ultimately, I've seen the markets go up and down a lot in my life. I've started hedge fund trading back in 2002, and I spent 3 years trading, and I saw a lot of ups and downs in that time frame. The market crashed quite a bit in that 2001 to 2000, end of 2002 time frame. And I can tell you guys from a long-term perspective, I've seen quite a few drawdowns in the market, quite a few panics in the market, 2000 to 2003, 2007 to 2009, 2018, 2020, and a lesser extent, 2022. I've seen all these, and I can tell you that as a long-term investor, one of the biggest things that you need to do is, first of all, not panic. If you've got a 10-year time horizon, there has never been a time in our markets over 10 years in modern finance, going back 100 years or more, where the overall markets have not returned at least a flat level of return over a 10-year period of time. And in most cases, with the exception of 2000 through 2010, which is called the lost decade, it was pretty flat to just slightly up. All the other 10-year periods have made quite a bit. And in fact, I'm sure you've heard this statistic in the past, but ultimately the fact is that most markets over 10 years plus, certainly over 20 years plus, return somewhere in the 7 to 10, even 11% range. And, recently with how good the markets have been up until about the beginning of April, that number, I think, had gone up a little bit and was well over 10% because of the last couple of years. So, markets are going to return well over long periods of time. They are not meant to be traded unless you're watching it minute by minute, hour by hour. And obviously, I've done that for several years in my life. I would not recommend it to most people. I remember being at my hedge fund, and there were people at the hedge fund that would have a terrible couple of days, and they just wouldn't show up back at work. And it was terrifying, that could have been me. It could be me in a month. And so, there's a lot of risk that you take when you take on short-term trades. I will say this: if you're interested in doing something like that, I always tell people, risk what you can afford to lose. So generally, my rule of thumb is, as being a registered investment advisor for many years as well, is that no more than 5% of your net worth, in some cases as little as 3% as you start getting up the earnings capability chain, so to speak. So, if your net worth is, say, under $500,000, then up to 5%. If it's well over that, then 3%. And I wouldn't risk any more than that, just because I feel like, for the most part, you're going to be a long-term investor. You can make more money being a long-term investor than you could trading There's nothing wrong with making a little bit of money trading, but I certainly wouldn't want to ever see you give up your retirement or give up anything else that you're doing for purposes of, taking an exorbitant amount of risk on a couple of trades or a series of trades. Now, I do trade actively, and I think I've made some videos on that. And I trade actively because I take a very small percentage of my net worth. And I know that at some point there is some gambling aspect to it, but ultimately I have enough understanding of the markets that I feel as though I have an edge on certain things. So I'll give you an example. Usually leveraged ETFs are not recommended for most people. They're not suitable for most people. However, leveraged ETFs tend to be very good instruments to use for trading when the markets are way, way down in a very short period of time with very high volatility. And the reason for that is because they typically trade futures contracts, and futures contracts have what they call decay over time. So you don't want to hold these positions for long periods of time unless you have some volatility and some big swings, so that ultimately you're not losing some of your money to the futures decaying. So the same thing goes for options. I'm a seller of options in 95% of all markets. The only time I buy options is if I buy options that are for leaps that are longer term, and I will ultimately buy a leap that has a very low implied volatility and just hold it almost as if it's a synthetic stock. So I've done this with Russell 2000, with IWM. I've actually bought leap options calls that are trading deep in the money. So for instance, in about a month ago, I bought some 150 calls on IWM, and obviously they're down. Market's down right now, but these leaps expire well over a year from now. And you buy them, and you can essentially control 100 shares of IWM at a significant discount. And not a discount to the market, but a discount because you're basically buying that time, and you're going along and taking some risk along with the time value of money over that year and a half time that you're going to own that option. So this is one way that you can leverage yourself without taking too much risk. But ultimately, the way that I typically play the markets that have been terrible right now is the fact that I will either do leveraged ETFs, and I will sell puts on those. So I'm hoping that the market doesn't go below a certain level, and I'll sell puts and buy and basically generate some income from my portfolio. When you sell a put, you get paid a premium, a credit, and then that kind of helps pad your overall losses if something does go down in value. So for example, I sold some 30 and 25 puts on TQQQ, TQQQ, which is the triple QQQ, which means it's 3 times the leverage on the normal NASDAQ 100. And I sold some puts on it when the market was way down the other day. And it is a risky bet, but typically, like I said, when volatility is very high, the market has come way down. Selling puts on those, you collect massive premiums because implied volatility is way up. And then that helps pad if this, the overall market continues to go down, it helps pad your losses. And I'm a big believer in selling into buying into a big sell-off like this, as well as selling puts into a big sell-off like this and padding yourself that way. And I don't plan on trading out of these quickly. I plan on holding these if I get exercised. So, if TQQQ goes below 30 or 25, then I'll own some of those shares. If not, then, so be it. I won't own any of those shares. So but I'll collect a premium just to sit and wait. And that's what I'm doing. So I was collecting 3 to 4% because the volatility has been so high. Usually you collect a lot less than that, but because the volatility has been so high and the market's way down, I was collecting a nice hefty premium for just holding on to some puts for a week. And, we're already halfway through the week and they're looking pretty good right now. And I would tell you this, that it is also important that when you do sell puts and similar and sell covered calls and things like that, that you need to make sure that you take profit off the table. This is one of the things that most traders forget to do. They forget that you as a market participant, you're not supposed to be making, massive amounts every single time you trade. In fact, most people lose on a majority of their trades. So well over 50% of your trades are losers. So the way that you get around some of this and you keep your losers small and let your winners run is that you have metrics that you say, okay, if I'm up more than 50% in a short period of time, you have to define what that is. Then you sell out of something or you buy back a sold option. And these are all important points to make, is that most long and short-term traders have price goals. They also have stop losses. They also have methodology that they look at on a consistent basis to make sure that they're not destroying their accounts. So they don't want to go back down more than a certain drawdown. These are all important points to make when you are ultimately attempting to be a trader and not a long-term investor. So I can get into that more, but I don't want to, have anybody, if you can reach out to me if you want to get into that more. But here we are about 12 minutes into the live stream. I still haven't had anybody come on, which that's fine. I just figured I'd live stream for a little bit, talk about what's going on. I feel like these markets are very jittery, mainly because there's so much uncertainty. That's the key word, uncertainty. Well, usually if you listen to people like Warren Buffett, is when blood is in the streets, that's when you need to be greedy. And I believe that, there may be some blood in the streets. There already is some blood in the streets, especially with some of the tech names that were down tremendously. I just saw something on CNBC yesterday that said Google is now trading at the same level it was trading at during the middle of the pandemic, which seems kind of crazy because we've known it's grown for years since then, yet it's trading at the same levels. And Amazon's getting pretty close to its pre-pandemic valuations. To me, that seems like a good buying opportunity. Now, would I buy necessarily right here with all the uncertainty and with tariffs and things like that? Not necessarily, but it might be a good way of saying, again, to sell some puts and wait for the stock to pull back even further and ultimately get a good entry price into a stock that I want to own for a very long time. I want to own Google for a long time. I want to own Amazon for a long time. I want to own the QQQs for a long time. I want to own Russell 2000 for a long time. All of these things are, markets and stocks that I want to own for long periods of time. And so I'm willing to, take a little bit of risk in a down market where things seem to be more, valued correctly now, and use this opportunity to get into some long-term investments. So I haven't made really any sales at all in my portfolio, but I am going to make some sales. And that actually is a topic that most people don't like to talk or don't know about, don't talk about, which is tax loss harvesting, or TLH, you sometimes hear it called. And this is also an important point in these kind of markets. Take advantage of downward markets. If you had a stock that you were up massively in for whatever reason, you traded out of it, you made a bunch of money last year, but you still own some shares, and now this market has crushed the remainder of those shares, and maybe you don't want to own that stock anymore. That would be a good opportunity for you to sell, take the loss, and write it off on your taxes. You're allowed to write off up to $3,000 in capital gains against your regular taxable income, and then the remainder can go against other gains that you have maybe later in the year, or you can carry forward losses for a very long period of time, which means that you can take your losses and not use them this year. If you have a great trading year or a great investing year next year, then you're in a position where those losses can offset gains in the future. And I was very thankful in 2024. I had a huge capital gain in 2024 due to the sale of a small business that my wife owned. And it was pretty unexpected on how much we owed, just because we didn't know how it was going to be valued. It had to be, valued at a small business level. And we were kind of shocked at how little it was valued at and how much we got for it. So we had to pay some capital gains. Fortunately, there were long-term capital gains. But my point is, I had about $10,000 in capital losses that I'd been accumulating for the last couple of years. And I was able to offset $10,000 in those gains from the sale of the business, which, saved me a pretty good chunk of money in taxes. So, all of these things are important when you're looking at these kind of markets. The tax loss harvesting, if another concept is, a lot of people and a lot of advisors talk about, well, look at what other options you have. So for instance, if you're in the Russell 2000, like I am, the IWM, well, I'm down, 15+% at this point. I could easily sell that, take the loss on it, and move into a slightly different but similar ETF, and ultimately capture a lot of the same the potential future gains, but be able to take that loss and offset some gains in the future as well. So these are all things that I find very interesting to look at in downward markets. And then I think the last thing that I want to just shout out, unless we have someone pop on here in the next 2 or 3 minutes, is the fact that you should always be considering your risk tolerance based on how much money you have invested in the stock market, your house, bonds, cash, gold, real estate. All these different things need to be determined, and you need to figure out how far away you are from retirement for long-term investing. You need to figure out how much of a loss you will bear and be okay with. And sometimes taking less risk is not a bad thing. Sometimes taking more risk is not a bad thing, as long as you have set up your portfolio to account for proper drawdown, proper ways of managing that risk and understanding what's going on in your portfolio, and you have the right time horizon picked out for your particular situation, then there's nothing wrong with that. So, well, guys, I'm going to leave it at that today. I don't see anybody hopping on, which I kind of figured might happen in the middle of the week. But I wanted to give everybody an opportunity to hop on and see if anybody want to answer any questions. I do appreciate everybody that subscribed over the last year. If you see this after the fact, and please hit that like button and tell everybody else about my channel. I'm going to bring a lot more updates on Fidelity, some more updates on some credit cards here in the near future. Thanks for tuning in. Until next time.